We are in the early innings of just how much our economy is going to be impacted by these interest rate increases. This is coming from Carolyn Rogers, who is a deputy governor at the Bank of Canada. We'll be discussing a little bit about what she said earlier this week. We'll look back and we'll see just how much the interest rate increases have already affected the employment market and obviously the housing market as well. We'll finish off the video by taking a step back, a look into history to see how the Fed has moved the interest rate higher and lower and how long it takes for that to creep into the economy. But if this is your first time here, welcome. My name's Nick and this is Ways to Wealth. Before we get into the video, I have a huge favor, a huge ask. If you learn something new or you get some value out of the video, hit that like button for me. I definitely appreciate that. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on for content similar to this. We post a video every single Sunday, so come back on the channel and come check it out. We'll start out, like I said, by listening to a little bit of what Carolyn Rogers said in her speech, and then we'll break it down from there.
Monetary policy works a bit like a chain reaction or a sequence of events, and that sequence takes time. Both history and research tell us that changes to the bank's policy rate affect different households and different sectors of the economy differently and at different speeds. If you're making a big purchase or an investment, one that requires a loan, you'll feel the impact of higher rates almost immediately. And the sectors that are most sensitive to changes in interest rates are the ones that cool first. The housing sector here in Canada is a clear example of that. Most of us take out a mortgage to buy a house. An increase in mortgage rates may cause us to delay a purchase or purchase a less expensive house. This leads to a slowdown in housing activity, and as housing activity slows, people tend to spend less on the things that go with houses, furniture, other housing-related goods. On the other hand, it takes longer for monetary policy to bring down price growth in other goods and services, especially in services, because they're typically not related to borrowing. Instead, they adjust over time as spending overall moderates. I mean, I guess I would clarify what the 2 years is a reference to is what we know is that it can take up to 2 years for the full effect of monetary policy to occur in the economy. It has to work its way through. It's that chain reaction or sequence of events that I described in the speech. So I don't know that we have a 2-year plan. We do have we are aware that the decisions we're making now won't have an immediate effect. They will take some time. So that's why we I laid out sort of the number of indicators that we look along the way to see whether things are evolving as we expect.
It is important to note that the Bank of Canada has moved 300 basis points higher in only a 6-month period of time, ending at 3.25 on the overnight rate. And when you think back, obviously she mentions that the housing market is the one that is probably going to be first affected, and then there's going to be other industries that follow. But it's important to note here that the time frame in which it takes the interest rates to come in could take up to 2 years. So we're going to break down and we're going to look at how these interest rates have already kind of crept into the economy, and just think later about how much further we could potentially have to go. So we had some unemployment numbers come out this week, and the unemployment rate here in Canada has jumped to 5.4%. The economists had originally projected that we were going to gain 15,000 jobs. It actually ended up that we'd lost just shy of 40,000 jobs. This marks the 3rd consecutive month in a row that we've actually had job losses, which is not great whatsoever. It gives you a sentiment as to how much businesses want to invest, especially with the landscape that they know that money is becoming tighter. It's becoming harder to get, more expensive. So why would they be looking at expanding business right now? And that does not look good for the job sector. We jump now to the housing sector, which obviously gets a lot of coverage, so we won't spend too much time on it. August numbers actually didn't end up that bad, but we do know there is a lot of fear in the marketplace. We do know that there's deals that are sitting on the market for a lot longer than they were before. You're starting to hear some things in the marketplace where it could be heating up again. Last week, we covered that Doug Porter from BMO mentioned that the rates could go higher because of this report in terms of total home sales increasing and the price staying stable, not too much variation there. But we do know that as these variable rate mortgages start to come in, I'm sure you've seen it many times this week, the trigger rate, many other things in terms of even fixed rate mortgages turning over. There is a lot more damage to come, especially when Bank of Canada has the tonality of this isn't it, we have more to come. So I think with all of that being said, what is important to know is just kind of, I guess, back up what had been mentioned by Carolyn to look through some examples of the GDP numbers and the Canada's interest rate. So we'll look at this first chart here. The interest rate is in blue, the dotted line is the GDP, and this is from a time frame just before the year 2000 all the way up until current periods. And we notice here 2008 there's a huge drop off, and that's obviously the 08-09 crisis, which is the first time we really got into this notion of dropping the interest rates really low in order to save the economy. And we definitely see that it took quite some years, whether it was confidence in business or so forth, after that 2008 period, almost creeping up into 2010 for the economy to really bounce back. So this is one period in which the interest rates were low for a couple years before the economy really showed its fight and showed that it could come back. We could also see later on in those periods with interest rate increases just after 2016 into 2017, we see that the GDP numbers at the top there kind of bend down, and that happens after like a 1.5 year period heading into 2020, and then obviously we go into the drop for the latest interest rate decrease. So we move on to the next chart here, and this chart will show you just before maybe 2005 all the way up just past 2014, and we see a huge decrease here, finishing off probably in the 2009 period. And it really took until 2010 after for the economy to really bounce back. So we see a delayed effect happening there. We'll jump over, we'll take a look at another graph here, which is the 98 period to maybe 2005, 2006. And we can see that the interest rate decrease right before the 2002 period really took a little bit of time to have that economy bounce back. Let's say 2003 before really we start seeing those increases in GDP numbers. So this is more on the increase side. It really is a difficult thing to look through in our economy where we've increased rates drastically, maybe that 2016 period that I had up. But we've really never gone through and seen what could happen on the downside. But I think what we're trying to pull out here is confirming what Carolyn said in the sense that it will take time for these interest rate increases to take its effect into the economy. And I think that is something to be aware of, especially if you're going to buy a home. Be very weary that interest rate or mortgage rates could go higher. Be careful about being in tech stocks. I mean, obviously our viewpoint should be extremely long, buy companies that can last for a long time. Just be careful of getting into interest rate sensitive sectors. Make sure you do your homework. Make sure you have your full due diligence done. As of right now, I don't know where we're going to end up. I don't have a crystal ball where our economy ends up at the end of the year. I don't have a crystal ball where our housing market ends up. But based on the facts that we have now, it will be down. I mean, there's no other way to put it. Bank of Canada is still persistent about raising the interest rate. In turn, all of those other things will get higher, the mortgage rate, etc. Housing will fall. The economy will suffer. By how much is the unknown, but it definitely looks like in the short run, there will be some pain. So I wish I had some better news for you. If you have differing thoughts or if you agree with me, throw them down in the comments. I'd love to hear what you guys are thinking. I hope you all have a great week in the market. Happy trading.